In today's episode, I'm going to talk about the things that you need to know when you're getting started as a trader. I'm not going to sugarcoat it for you. Trading is hard. And one of the challenges with trading is that there are so many mistakes that beginner traders make, and they end up shooting themselves in the foot hardly before they've even gotten started. They knock themselves out and they become a statistic of another failed trader. So even if you've been trading for a while, but without a lot of success, it's not too late to take a step back, to slow down, and to start focusing on building a really solid foundation that you can scale. I'm going to share with you the blessing and the curse of being a trader. The curse: you could spend years struggling to make even just $10 a day, and you'll feel like, I'm not being greedy. I'm not asking to fly a private jet or drive a Lamborghini. It's $10 a day. Why is this so difficult? And it's because until you have a set of rules that you consistently follow every single day, you won't make $10 consistently. But now here is the blessing, and this is the silver linings for so many traders. Once you are consistently making $10 a day, and let's say you're doing that with 100 shares, the only difference between $10 a day and scaling up to $50 to $100 to $200 a day is increasing your share size. And you can easily do that as you gain some confidence and you have a track record that supports putting a little more money behind each of your trades. That's exactly what I did with my trading. And now I trade with an average position of about 10,000 shares. And that's the biggest difference between my first few months of turning the corner and the amount of money I'm making today. Bigger share size. Okay, so my hope for you is that in this episode, I'm able to point out a lot of the rookie mistakes that many traders make when they're getting started, and I was no exception, in hopes that I can help you avoid making those same mistakes. I'm also going to share with you the 5 steps that I would take if I were starting over today. So let's go ahead and jump in with the first step that you need to take when you're getting started. The first step is simply learning the basic concepts of how to actually take trades, how to do technical analysis, how to read candlestick charts, how to read the level 2, the tape, how to interpret news. It seems like a lot. And on the one hand, it is. But on the other hand, for me, when I started getting into trading, I was so excited to learn all this stuff because I knew that once I learned it, it would empower me, right? Financial literacy. That would empower me to become potentially a better trader, a more successful trader, more profitable trader. So I was super motivated to learn all of the different nuances of how to trade. So step 1 for me, I'm not really good at like reading an owner's manual for trading software or just reading a book about how to trade. The easier way for me to learn is hands-on. It's to actually start taking my first trades. Now, I want to say a rookie mistake, and I'll kind of, pepper these in throughout this episode. One big rookie mistake is trading with real money before first proving you have a track record of consistency in a trading simulator. A lot of beginner traders, they'll just fund an account with Thinkorswim, Robinhood, whatever the account is, doesn't matter, E-Trade, and they start taking positions. And unfortunately, this can be a very slippery slope where next thing you know, you're trading with big size, you're taking YOLO trades, you're swinging for the fences, you're going into the red, now you're praying for a Hail Mary to get yourself out of the red. And it's just very emotional, it's very stressful, and it's completely unnecessary. It's not the right way to start. So while on the one hand, I'm a big advocate of just throwing yourself in and starting a trade, I would just say as a note, do it in a simulator because you'll get the same learning, but you're not losing real money. Right now, for some of you, you've already been trading for some time and you have been losing money. And it might be hard for you to say, I'm going to step back and switch to simulator because it feels like a step in the wrong direction. So if you're in that position, let me give you one possible word of wisdom. Something you could consider doing is reducing your shares all the way down to like 1 share or maybe 10 shares, something really small. So the amount of money you're losing is negligible, but you're still gaining experience, and maybe even better than sim trading, you're still feeling some of the emotions that come with gains and losses, because ultimately you will, at one point or another, sooner or later, have to begin conditioning yourself to experience loss and not let it get you rattled, right? So step 1 is learning the basic general knowledge of trading and how the markets work. And I really think one of the best ways to do it is by opening a simulated trading account and taking your first trades. When you take your first trades, you're going to force yourself to learn the basics of the different types of orders. You've got market orders. Those work from 9:30 a.m. till 4 p.m. You've got limit orders. Those can work from 4 a.m. till 8 p.m., depending on the hours of the broker that you're trading with. Now, if you're trading with a broker like Thinkorswim, they're only open from 7 a.m. till 8 p.m. So it depends a little bit on the broker that you're trading with, but these are the things that you'll learn as you begin practicing in that safe, simulated environment. You'll learn about how stop orders work. You'll realize that stop orders, like market orders, only work between 9:30 and 4 p.m. Pre-market and after hours, we have no market orders, no stop orders, so it takes a little bit, it's a little bit riskier. There's a lot of volatility pre-market and after hours, but you have to use limit orders. You'll begin to learn about the offsets that you can use. For instance, let's say you want to buy a stock trading at $5. You'll learn you could put a limit order at 5.05, 5 cents above the current offer. And by doing that, you have a better chance of filling your full position. If you don't do an offset, well, what if there's only 100 shares for sale at 5 and you want to buy 5,000? You wouldn't fill the full order. So you start learning about offsets. You start learning about the right indicator to press that buy button. What am I looking for that ultimately gives me the conviction to send that order? Is it green on the tape on the time and sales? Is it the first candle making a new high on a candlestick chart? Is it an indicator crossing over like the MACD or RSI reaching a certain point? That'll all depend on the strategy you trade. But ultimately, the first step is just learning all of these basic concepts of trading. Learning how to read the news. What are the types of news headlines that move the market? And what are news headlines that are kind of negligible? They don't really do anything. Learning about quarterly earnings. Maybe perhaps even getting into that earnings statement and learning how to read it. Learning to recognize the balance sheet and what it looks like, what a good balance sheet looks like, what a bad balance sheet looks like. Learning what a shelf registration is. These are all kind of the basic things that you begin to learn during your first few weeks and your first few months trading in a simulator. Now, once you've laid a solid foundation of all this general knowledge about the market, it's time to take things up a notch. So now, let's talk about step number 2. The second step of learning how to day trade is learning one simple strategy. This is something that a lot of rookie traders make a mistake with. They try to trade many different strategies at the same time. Maybe they're trading options, they're trading large caps, they're trading small caps, they're buying some meme stocks like AMC and GameStop. They're doing a little bit of everything, and they have mixed results. There may be some strategies that are more successful than others, but it's hard for them to tell because they're doing a little bit of everything. The only way to really accurately know what is actually working when you're approaching trading in that way is by taking really detailed notes about every single trade you take. That way you can go back and you can sort all of your trades based on the strategy that you were implementing at that time. And while there's nothing wrong with doing that, most beginner traders won't do that. They'll be shooting from the hip, doing a little of this, a little of that. They'll be inconsistent. And then as a result, they just don't know what to do. And eventually they give up. So at the end of the day, I would say, honestly, success in trading comes down to 2 things. Having a strategy, number 1, and number 2, having the discipline to follow it. Because when I see traders who end up blowing up their accounts and leaving, it's for one of 2 reasons. Either number 1, they didn't have a strategy at all. They were just sort of shooting from the hip, doing a little of this, a little of that until they blew up their account or gave up. Or number 2, they have a strategy, but they don't have the discipline to follow the strategy, which then is basically just as bad as not having a strategy at all. It's actually worse because you think that you know what you're doing, but then you lack the discipline to actually follow the rules. So you have confidence on the one hand, but then you continually make the same mistakes again and again and again. Now, regardless of which position you're in, if you haven't learned a strategy yet, then we're going to talk about that in just a moment. If you've already learned a strategy, but you're struggling with discipline, I can help you with that too. Discipline is a muscle. It's something that you strengthen with exercise and practice. And let's be honest, it takes time to become a disciplined trader. It doesn't happen overnight. And it's something that even now, after more than 10 years in the market, I still struggle with at times. So we can forgive ourselves because we are only human and we're trying to do something that is honestly very difficult. Being a successful trader is not easy. But let's start first by talking about strategy. So step number 2 is learning one simple strategy. Now, for me, there's two strategies that came naturally to me when I was getting started. One of the strategies that came naturally to me was focusing on reversal trades. And the reason I focused on reversal trades was because I had kind of a hard time when I would look at stocks that were squeezing up, knowing when to get in. Now, if we look at this stock here and we look at the chart, we would see that naturally there are some pullbacks. And at this point, you'll know that I'm a big advocate of buying these pullbacks and then selling into the move up, buying pullbacks and selling into the move up. But for some beginner traders, it's just a little hard to get their head around buying these pullbacks. And it's actually easier instead to look for stocks that are going up and then try to catch the reversal coming back down, or to look for stocks that are going down and to try to catch the reversal going back up. So I actually developed a specific scanner for that type of strategy. It's called a reversal scanner. What this reversal scanner is doing is it's looking for stocks in real time that are really extended. So this stock right here, I'm going to just put this up here, for instance, has 11 consecutive 5-minute candles. Now, you look at this and maybe we don't like this particular stock, but there's no denying the fact that 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 green candles in a row is quite extended. Catching the first candle to go red and then riding that momentum back down could be a nice opportunity. Now, unfortunately, this was coming right into the close, and going into the close, some of these stocks don't have a lot of volume after hours. So it's a better scanner for trading during the day than right at the close. But this is another example where you've got 1, 2, 3, 4, 5 green candles in a row, and then you would be looking for that first candle to go red to pull back down. Now, a reversal strategy, like any other strategy, is going to have a system of a set of rules that will dictate the type of stocks that you buy, when you get in, when you get out, the time of day that you trade, some technical indicators that you may reference. It's very clearly documented, and it has a track record that supports you trading it. Now, for you as a beginner, you may be like, well, that's all fine and well. How do I find that? So what I'm going to do is I'm going to put a link for you in the description, and I'll pin it at the top of comments, and it's a link to download the PDF of my small account strategy. It's a strategy that I use in my trading. Now, although reversal trading was something that I liked quite a bit when I was getting started, ultimately, you know what I learned? It's really hard to trade against the trend. It's hard to time those reversals. So while it seems to make sense to watch something selling off and then catch that wave back up, I actually found that for me, it's a lot easier to buy something that is already showing strength by buying a trending stock during one of its nice, gentle pullbacks. Learning how to find those entries, for me, was a little more challenging, but once I got them dialed in, it was much more rewarding. And so for me, one of the patterns that I trade pretty much every day while I'm trading is a pattern that I call the first pullback pattern. So I look for a stock that's squeezing up, kind of like this. So a couple of nice big green candles. I let it pull back a little bit, just like this. And then I'm going to look for that first candle to make a new high. Now, this next candle, it opens, and if it goes red, I'm not buying. If it keeps going red, I'm not buying. But as soon as we have a candle that makes a new high like this, green, I'm in on this candle, and my max loss is right down here at the low. And then riding the momentum back up. Now, it's very important when you're trading this pattern that you apply it to the right stocks. If you try to apply this pattern to the wrong stock, you're going to have inconsistent results. So part of my strategy very clearly dictates what is and what is not the right type of stock to trade. So GameStop, for example, certainly can be the right type of stock to trade on most of the days that it has high relative volume. That's something that is really important for me in my trading strategy, to focus on stocks that have volume, have liquidity, and typically they have a catalyst that is creating all of that. There's some type of news event. Again, as you go through step one of practicing in a simulator, trading different stocks, you're going to notice that some stocks move a lot faster than others. And you're going to it may take a little bit of time, but you'll eventually recognize that there's a pattern and a connection between the stocks that move faster and the reason that they're moving in the first place. Stocks that have a catalyst move faster than stocks that are just trending with the overall market. If the overall market is going up, we've got the S&P 500 moving up, then it's very common that a lot of stocks will just sort of trend up with it. But that doesn't necessarily mean they're good candidates to try to day trade. Because if we're going to day trade something, We need the liquidity that will allow us to buy and sell 10,000 shares relatively quickly. Now, it's true, as a beginner, you might only be trading in the simulator with 100 shares. And then when you first transition to real money, you might only trade with 50 shares. But eventually the goal is to be trading with 5, 10, 15, 20,000 shares. And you're not going to be able to do that trading stocks that aren't liquid. So the liquidity, the volume comes from news. If you just think about it, why would a stock have high volume? Why would people be super interested in trading it? Usually it's because there's some type of fundamental catalyst. Earnings, for instance, new contracts, these types of things bring investors off the sidelines to actively trade that stock on that particular day to try to capture a piece of that opportunity. So now the third step is to practice the strategy that you learned in step 2, either in a simulator or with real money, but with really small size. I'm an advocate of simulated trading because I just think it's safer. Step 1, learning the basic terminology of the market, the general concept. Step 2, learning a strategy, adopting it, has a set of rules, has a track record, gives you confidence to practice trading it. Step 3, practice trading that strategy. When you're practicing that strategy, you have to make sure you're following all of the rules that have been laid out. Those rules will dictate the time of day that you trade, the stock selection criteria. So for me, I only trade stocks, generally speaking, between $2 and $20 that have 5 times relative volume, are up at least 10% on the day, have a float of less than 20 million shares, and have a news catalyst. I know those 5 criteria for me. If I look back at my historical data, my biggest winners will all meet those 5 criteria. And when I start looking at some of the stocks that I'm not doing well on, well, they're usually outside that criteria. So as a beginner, it's really important to hone in on the type of stocks that other traders are trading, the strategy you're learning, with the most success. This is the thing with trading. It doesn't really make sense to try to reinvent the wheel and start from scratch when there are other people out there who have been doing this for a long time and who are happy to share with you what is actually working for them in this market. I'm just one of these people, but there are many others out there. The only thing I'd caution you on is making sure the person you're learning from is actually profitable. I have my broker statements on my website and they're audited, so you know beyond a shadow of a doubt that my gains are real. I turn an account with less than $600 into more than $10 million, and I continue to trade in that account today. I'll tell you, my results are not typical. I'll be very transparent there. I've had a very exceptional career in a lot of ways. Certainly there's people that have done far better than me, but I want to put that out there for you. I think even though you shouldn't assume that you'll achieve a similar result as me, that it is important to learn from someone who is proven profitable. You know, there are some people who say, well, you know, there's a lot of professors in college and this and that are great at teaching, but they're not really, you know, they're not actually practicing what they're teaching every single day. And I think on the one hand, that's okay when you're learning general theory of the financial markets. But when it comes to actually learning a strategy that you can trade every single day, I think you want to learn that from someone who's actually got their money where their mouth is, who's actually trading that strategy. And as you know, that's what I'm doing. Okay, so step 1, learning the basic concepts. Step 2, learning a trading strategy, an actual strategy with rules. Step 3, practicing that strategy in a simulator. Now, step 4 is evaluating your metrics. And this is a super important step. In fact, evaluating my metrics is the reason that I was able to turn the corner. Because when I was getting started, I was really diligent about tracking all of my trades in an Excel doc. I took my first trades, it was paper trading, it was pretend money, in the late 1990s. And I opened my first real money account in 2001, so now 23 years ago. The first thing that I did when I took my first position was I opened a ledger and I wrote the date, the name of the stock, the price I got in at, the number of shares I bought, and the reason I was buying. I essentially wrote a little essay of all of the reasons that I liked this stock. And I was buying stocks, shares of companies that I knew at that time, which is not a day trading strategy. But nonetheless, I then took that same approach when I began day trading of taking notes about every single trade I took. This was super important because then I was able to go back and analyze my trades, and I was able to categorize them by each of these different data points. Now, of course, thank goodness I started using Excel because it's so much easier to sort the data in those different columns. So what I would do is I would sort all of my trades based on time of day. And then I would see, interesting. I'm noticing a pattern based on the time of day that I'm trading. I make more money in the morning than I make in the afternoon. Maybe, just maybe, I should stop trading in the afternoon. And that was a conclusion that I came to. And so what I did as a beginner is I would focus on trading in the morning, and then I had other things I was doing in the afternoon that was helping me save money, ultimately. It wasn't making me a lot of money, but it was helping me save money. So things I was doing, I was splitting firewood, cutting down firewood from trees in the woods at my house in Vermont, because I was going to use that firewood to heat the house in the winter instead of buying home heating oil. That was going to save me $4,000 or $5,000, right? So I did that. I was painting the house just a little bit each year so I could avoid having to pay someone else to paint it, because I felt I was perfectly capable of painting the house. And it wasn't a really tall house, so it's an old farmhouse, but it was easy enough for me to paint just with a regular ladder. So these were things that I was doing that was helping me save a little bit of money, fixing my own car when it would break, that sort of stuff. So I got into this little habit of trading in the mornings and then doing other things the rest of the day. I looked at my metrics and I noticed I was making more money on stocks between 2 and 20. In fact, it was the higher priced stocks where sometimes I had really big losses. Because, you might buy a stock at $35, $40 a share, and then suddenly it drops $5 a share. And you're down 10 grand on 2,000 shares. And you think, I wasn't thinking anything like that could happen, but there it is. It just happened, and it can happen really quickly. So, I learned a lesson from that. I learned about the stocks that I made the most money on were typically up at least 10% on the day. They typically had high relative volume. And so it was in my metrics that I learned my strategy. I didn't sit down and sort of just be like, I think I should trade this, and this. I traded everything. I looked at the data, and then the data told me where I was making money. And that's the strategy I continue to trade today. That's the strategy that I'm sharing with you right now. The reason I want you to track your metrics is because I want you to compare where you're at versus where other traders are at who are also trading the strategy. So let's say you practice the strategy you learned in step 3 and you're analyzing your metrics in step 4, and you notice, I'm only right 55% of the time. Whereas Ross and these other traders who are trading the same strategy are right 68% of the time, maybe 70% of the time. So you think, why is that? What am I doing wrong? And then that's the opportunity to try to figure out what you're doing differently. So what is the difference there? Are you getting in too late? You're buying too high? Are you taking too many trades? Are you trading some of the wrong stocks? Are we trading the same stocks? Are you trading different stocks? And this is a really exciting process of almost being like a little, like a scientist, because you sort of come in with a hypothesis, you then have data, you analyze this set of data, you compare it against other sets of data that you see from other traders, and you try to draw conclusions. What should I do differently? Then you create a new hypothesis. Okay, so for the next week, I'm going to focus on making this slight revision. You do that for a week, then you get another set of data. And you keep doing that, you keep doing that, you keep doing that until you finally have a set of data, your own track record, that is showing consistency and profitability. You will not get it if you do not learn discipline. So like I said, strategy, you have to have a strategy, but secondly, you have to have discipline. So something that I've struggled with through my career are the emotions that come with trading. When I started trading, I was trading with money that I got from my father after he died. And that for me created a real emotional attachment. It's almost like, if your father left you an old leather jacket and, you trade that in for $500, and now this $500 suddenly has such symbolic meaning. This was my father's, it's all that I have left of him. And aside from the memories. And so for me, when I started trading, it was very emotional. I ended up eventually finding out about this book called Trade Mindfully. I found this helped me a lot when it comes to the emotions. This was written in, I don't know the year. Let's see. This was written in 2015. So I'd already been trading for some time when this book came out, but I really did find it very helpful. And I recommend it to a lot of beginner traders, especially traders who do struggle with emotion. I think it's a really good read. I would also recommend this book right here, Quit by Annie Duke, The Power of Knowing When to Walk Away, and a second book by Annie Duke called Thinking in Bets. Annie Duke is a professional millionaire poker player, and although she's not a day trader, she certainly understands the concepts that we deal with and the emotions that we deal with because, being a professional poker player, it's no longer gambling when it's not a game of chance. She's got a strategy. She's got a set of rules. But if you don't follow them, you're going to have problems. And so one of the things that I learned for me was that both a combination of exercise, meditation, and reducing caffeine intake made me a better trader. It made me a more disciplined trader. It made me a calmer trader. I slowed down a little bit. And, I'll have caffeine when I'm done trading. But at this point, I do not have caffeine before I start trading. And I know that's hard for some people who, look, I love caffeine as much as the next person. But I really found for me in my trading, it gets me too amped up. It gets me too fast to kind of spiral when I start getting emotional. And it's better for me to be calm, cool, collected, and zen while I'm trading. And then when I'm done, I'm done. So I encourage you to practice meditation, to practice exercise, and to really start to develop a sense of emotional awareness about how trading is making you feel. Because once you can understand what your triggers are, that's like half the battle. Because then all right, I just had a trigger. I need to walk away right now. Because the thing with trading and emotions is that once you cross that point of no return, it's like you're gone. You're in a state that I call emotional hijack. And it happens to a lot of beginner traders, but it happens to seasoned traders as well. You go into emotional hijack and next thing you know, some really crazy stuff can happen. And you'll come back later and be like, what was I thinking? And the reality is you were not thinking, because in those moments, you were completely hijacked by your emotion. It's a really dangerous place to be in and to trade. So step number one, learning the basic knowledge, basic concepts of trading and the financial markets in general. Step number two, learning a strategy. Ideally, a strategy is being traded by other people profitably. That's a great starting point, much better than starting from basically nothing. So make sure you download my small account strategy pinned in the top of the comments and linked in the description. Step number three, practicing strategy in simulator. Step number four, analyzing your metrics. Step number five, time to switch to real money. Now, here's my 2 cents when it comes to when to switch to real money. Ultimately, your metrics are going to tell you. You need the metrics to support trading with real money. If you can't make money in a simulator, you have no business putting real money on the line. You just don't. That's the reality. So look at your metrics. Once you have, and it's not just like a couple of days of good metrics. Once you have weeks, 5, 6 weeks, a couple months, 2 months, maybe 3 months of good, consistent metrics in the simulator, that's when it's time to consider trading with real money. So one of the things that is really important for me to see in a trader in the simulator is that they have gone through one very important process. They've traded in the simulator, they've had several weeks of consistency, and then they had their first drawdown. Having your first drawdown and recovering from it is a huge emotional achievement. Like, it's just such a big deal because now you know that the strategy you're trading is really working and that you have that composure. One of the problems that some people have is they'll have this nice streak here and they'll go live, right here. They've never had a drawdown, and maybe it's just bad timing, but they have a drawdown as soon as they trade with real money. And then they're like, well, oh no, was it the strategy? Was it this? Was it that? They don't know. And then they start to panic, and then things start to unwind and get really bad. So it's important to trade in a simulator until you've had your first drawdown and recovered it. The recovery is so key, because then when you start trading real money, if you have a drawdown, you'll say, this is no big deal. I've done this before. I know what it's like to go through a drawdown. I know as long as I stay calm, cool, collected, I can recover those losses. That is huge. So big advocate of not trading in the simulator for too long. The reason is when you trade in the simulator for too long, you can use it as a crutch. You begin to think that you'll make millions of dollars as soon as you flip the switch live. But there's one thing you can't simulate in a simulator. You can't simulate the emotion that comes with trading. Because when you start experiencing real loss and real gains, things change a little bit. So if you're trading in a simulator using 10,000 share positions, that's not realistic. Do not start with real money with 10,000 shares. The euphoria that'll come from hitting $5,000, $8,000 winners will be huge, and the pain that comes from equally big losses will be too much to bear. So ultimately, I think a simulator is a tool that you should use to learn how to trade, to master a strategy and to do it just with 100 shares and focus on $10, $15, $20 a day. And you could spend, as you'll learn, months, maybe years, learning to consistently make $10 to $15, $20 a day with 100 shares. But once you're doing it, switch to real money and then start to scale up. If you can do it in a sim, you can do it with real money. I'm a big believer in that. As long as you're not, as long as you're not doing something that kind of is I don't know, hacking the system. I mean, you can't really do that with 100 shares, but sometimes people will find little sort of things that they could do. Maybe they're trading in and out of halts, and some simulators will let you buy shares even when a stock is halted, for instance. You can't do that with real money. So as long as the strategy you're trading translates to real money, then switch it to real, trade with 100 shares and slowly increase. 100 shares a week, just slow and steady, slow increase, slow increase, slow increase until you finally get up to 1,000, 2,000, 4,000 shares. Once you get up to there, that's when things get really exciting. Now, I have a few more rookie mistakes that I want to caution you against. The first rookie mistake that I've talked about extensively already is trading with real money before you've got a proven track record. You set yourself up for failure by doing that. You get emotional. It's just a mistake. Mistake number 2 is not tracking your metrics. If you don't track your metrics, you have no idea what your accuracy is. You don't know what your average winners or your average losers are. You don't know what time of day you're making money. You don't know the price range stock you're making money. You know nothing. You're trading blind. You're going to lose money if you do that. Don't trade with real money until first proven consistently in a simulator, and track your metrics. You've got to track your metrics. Now, a third mistake I see a lot of beginner traders make is they invest in really expensive tools. Now, there are some basic tools that you need in order to trade. You need good charts, including ideally 10-second charts. You need stock scanners, but you do not need to spend $2,000 a month on a Bloomberg terminal. You don't need to spend $10,000 on a trading system. Now, I've got kind of an elaborate system here, but I've been doing this for a long time. And of course, I'm making YouTube videos like this. So, I've got my whole system set up, but you don't need something this complex. You could start with a simple laptop, a simple desktop computer, 1, 2, maybe 3 monitors at most. You don't need to spend a ton of money. Right now, it's all about proof of concept. Can you prove that you're worth investing in? And then once you can, then it makes sense to begin investing a little bit more. Now, another rookie mistake that a lot of people make is they'll feel this desperation to make money quickly. They want to make money today. They don't want to wait. And so they'll say, well, look, hey, Jim Cramer, I don't know, some of these guys on CNBC, the Nigerian brothers, whatever, some of these guys, I'm not sure all of them, but some of them will have alert services that you could subscribe to, and they'll send you a text alert and they'll say, I bought this stock, I bought that stock. But this is not really a good way to learn how to day trade. One of the problems, and I tried using these services myself and I didn't find any success with them. The problem is on winners, if they buy and it's a good trade, by the time you get the alert, the stock's already gone up. You've now missed the right entry. And so your winner is going to be smaller. Now, if it's a loser, well, ultimately, they're going to cut the loss first because they're going to be smarter, know exactly when to get out. So your losses are going to end up being bigger. Small winners, bigger losers. It's just not really a recipe for success. I'm an advocate of teaching you how to fish and not just feeding you little fish here just like that. That's not what I do. Now, probably very well that I do stream every day when I'm trading. And so you can watch over my shoulder. You can see me trading. And I do share with you what I'm doing. But I'm doing it in real time. And I'm not doing it because I want you to blindly follow me. I don't think that that's a good idea. So don't buy into those trade alerts. Don't try to blindly follow me, certainly, but anyone else, because it's really not a way to learn to become self-sufficient and independent. And isn't that why we want to learn how to trade? We want to be our own boss, right? I think we love that freedom and that independence. And so you need to be able to learn a strategy for yourself. So that's really important. It's just something I've seen so many people fall into that rabbit hole. And there's a lot of services out there that promote alerts and text, email, et cetera, but I don't think it's a good idea. Another mistake I'll occasionally see people make is they'll think, the market's not really hot enough right now. It's not, we're not in the pandemic. Maybe I should just wait until the market gets a little bit warmer, a little bit hotter. So something that I'll say about that is the best time to learn to trade was 5 years ago, before the pandemic, so you could have capitalized on that incredible hot streak. But the next best time is now. Because here's the problem. If you learn how to trade in the middle of a really hot market, you're not going to be able to fully capitalize on it because you don't have the skill, you don't have the intuition, you haven't been trading long enough. So people that began during the pandemic when the market was really hot, well, some of them joined during a time and joined the market when it was a little more forgiving, and maybe they could make money a little bit more easily than during a choppier market. But I don't think they were able to fully capitalize on the opportunity that was in front of them. And I'm afraid they may have learned some bad habits, because you can get away with holding a little too long during that kind of market. In a colder market, you have to learn discipline. So if you can learn to trade consistently and profitably during a cold market, I think that that's going to set a really strong foundation for you. And then when we have the next hot cycle, you're going to be able to capitalize on it that much better, because you've already got all this time in the game before the market heats up. So I think that really is the best time to learn. I learned during a time when the market was still recovering from the Great Recession. We were dealing with quantitative easing, this federal stimulus program, and then they were tapering. And it was just this crazy time when it was really hard to trade. And if you were up 10, 15, 20 cents a share and you didn't take that profit off the table, you were making a mistake. You learned that you had to pay yourself. And so traders that made it during that time were really disciplined. They took their profit and they locked up base hits. And for a lot of us, the pandemic was a little bit hard, because we were like, wow, these stocks keep going higher. It feels like people you could just buy and everything goes up. It's like not how we learned, but many of us did very well. We had the best years of our career during that window. And we're grateful that we were experienced enough coming into that hot market to fully capitalize on it. Hot markets, cold markets, it always goes in ebbs and flows. And even within a period of a hot market, I had red months during the pandemic. I had months that were cold. So, there were months that were crazy good, months that were cold, and that was still within the context of a hot market. So hot markets still have up and down, cold markets still have ups and downs. So I'm really kind of a believer that you can't time the market. So the best time to start learning is basically now, if you didn't already start, just to begin developing your financial literacy. The more you learn about the market, the more you're empowering yourself. You'll be able to take advantage of things like IRAs, 401ks, maybe 529 plans. You'll be able to be a real participant in an active way in this market. It's a shame that we don't learn more about the financial market in school, because ultimately everyone in the US has the opportunity to benefit from it, certainly through employer-sponsored plans like 401ks and IRAs and stuff like that, pension funds potentially. And so the fact that we're not taught this is crazy to me. It's just insane. So I'm glad that you're taking the time right now to start to learn about the market. And even if you're focusing primarily on day trading, it's going to make you more knowledgeable about the market at large. And that's going to educate the decisions that you make when it comes to long-term financial decisions. You're going to better understand the risk in trading. Because let's be real, trading does carry risk. When we think about the type of risk involved in trading, a lot of beginner traders confuse risk on each trade with the total amount of money you put into the trade. And I like to think of the money that I put into a trade as a tool. So if I have $25,000 in my trading account, just for instance, that money is a tool. So when I buy a stock, and let's say I buy a full $25,000 worth, some people will say, Ross, you're risking 25 grand. That could go, you could lose the whole 25 grand. And I would generally disagree with you, because the only way I would lose 25 grand is if the stock literally went to zero. Okay, stocks are volatile, but unless I'm trading a stock that is in potential bankruptcy proceedings or has the risk of imminent bankruptcy, I'm not worried about it going to zero. And even when they do go into bankruptcy, they still don't go to zero, because then there's people that are buying the stock and still trading it on speculation that they'll recover from that. So for me, the way I think about it is my risk is, let me kind of draw it here for you. So the way I think about risk is, let's say I buy a $25,000 position. So let's say I buy 10,000 shares of a stock at $2.50. So that's my entry. Okay. Now I'm not going to hold it till zero. So what is my max loss? I could calculate my max loss based on dollars, and I could say the most I'm willing to lose on this is $1,000. All right. Now for me, that's a relatively moderate max loss. My max daily loss is $5 grand. So losing 1,000 is not a big deal for me. So, all right. Well, 10,000 shares, that means I could risk minus 10 cents. So that means my max loss is $1,000 and it's at $2.40. There we go. So I'm using $25,000 of capital, but my risk on this trade I would consider to be $1,000. So if it goes up to 275, let's say, and I sell it for plus 2,500, I would say I risked 1,000 to make 2,500, which means I had a 1 to 2.5 risk to reward ratio, which is terrific. With this, I could actually be wrong 70% of the time and still make money. Your break even is less than 30%. So this would position you really well if you trade like that. And some people would say, wait, you risk 25,000 to make 2,500. That's not enough reward. And I think traders who are thinking like that are wanting to buy the YOLO options trades that have the potential to give them a 300x, a 3x return, where they're putting 25 in, they're taking $75,000 out. But that's not realistic, and that's not what most day traders are doing. You might get that once in a blue moon on something like a GameStop, but you're not going to be able to achieve that consistently. There's no way. No one's able to do that. I mean, really, let's be honest. So you have to focus instead on what I think are relatively small base hits and thinking of trading and the risk you're taking as really the difference between your entry price and your max loss. That's how I think of risk. And I think of my account essentially as a tool. So for instance, if I was thinking about buying a piece of real estate or something like that, and I'm thinking about improving it and stuff like that. Let's say I'm thinking about buying for $500,000. I want to put $50,000 of work into it and then resell it for $650,000 or $700,000, something like that. So that $500,000 really is a tool. It's a tool that I'm using that allows me to then put some money in, fix it up, flip it, and then get all that money back out and use that same money as a tool for the next project. And that's how it is with trading. So the equity, because you now own something of value, right? You own something that other people will buy. So I can turn around and sell this at $2.40 or whatever the case is. We look at something like GameStop, and sure, it's really volatile. And this is a stock that can go up and down, 20, 30% in one day potentially. So you have to be thinking about the risk on this type of stock as being wider. And so whenever I look at a stock like that, I think, okay, well, I've got to adjust my position size because realistically, I might want to take 10,000 shares and risk only 10 cents, but then is that achievable on this particular stock? And if it's not achievable on this particular stock, then I have to make the decision to reduce my share size, right? What's a realistic stop on this stock? Maybe it's $1 a share. So maybe I've got to go down just to 1,000 shares. And that's fine. I'll go down to 1,000 shares. So that's sort of the process of thinking about risk in trading. We know trading is risky, but one of the things that I think is that the people who trading is the riskiest for are the people who are not spending time thinking about strategy and how to develop an edge. An edge gives you the ability to pull profit out of the market consistently. Now, the thing that's a shame is that if you have an edge in Las Vegas and you're really good at blackjack, whatever your edge is, maybe you're counting cards, they'll kick you out of the casino. They don't like that. That's not true on Wall Street. If you have an edge, as long as it's not insider trading, but you have an edge, you're allowed to have that edge. And that's what gives you the ability to trade consistently every single day. You're not going to get kicked off your broker. Your broker wants you to make money. The casino doesn't want you to make money, but that's not the way Wall Street is. So on Wall Street, we are rewarded and encouraged for having an edge. I want to help you develop your edge so you could trade in the markets consistently every single day. Now, as always, I'll remind you that trading is risky and my results aren't typical, and I can't guarantee that you'll find success. I can't guarantee that you'll have the discipline to follow the rules. You need to have a strategy, and I can give you that, but you need to come to the table with discipline. There are certain aptitudes that make someone more likely to succeed: an ability to be disciplined, an ability to understand how to use trading software, how to trade, how to use a computer. There are some sort of peripheral skills that will lend themselves to being a trader. And certainly there's lifestyle considerations. Trading is great for people that are freelancers, great for people that have, online businesses, things like that have the flexibility to be able to trade for a few hours in the morning and then do the rest of the work that they have to do later in the day. For people that are working a 9-to-5 job on the East Coast, it can be tough, but I'll tell you something that's really nice. Beginning during the pandemic, people started trading earlier. So now the window really for most traders is between 7 a.m. and 11 a.m. And even if you only trade from 7 to 8 a.m. each day before you go to your 9 to 5 job, that's an hour a day of gaining experience. Think about where you could be a year from now if you spend an hour every day, Monday through Friday, learning about trading, focusing on trading, practicing in a simulator. You're going to know a heck of a lot more than you know today. So let's keep the journey going. And if you want to check out my strategy, it's linked in the description. There's a PDF. You can download it, print it out, start practicing that. If you want to become a member at Warrior Trading, we've got a 2-week trial. You could try it for $20, see what it's like. I'll put a link for that in the description as well. And if you enjoyed this episode, I hope you hit that thumbs up, and I hope you subscribe to the channel for more episodes about trading strategy and daily recaps just like this. I'll see you for the next episode real soon.